I need you to stop everything right now and watch this video all the way through. Not because I want your watch time, not because I need the retention metric, but because what I am about to show you is the kind of information that has a very specific shelf life, and that shelf life is measured not in days or weeks, but in the window between when a signal appears and when the market acts on it. That window is open right now, and it will not stay open. Watch this complete. No skipping. No 2x speed. Every section of this video builds on the one before it. If you jump ahead, you will have a fragment of the picture. And in a market moving the way silver is moving right now, a fragment is not just incomplete, it is dangerous. Here is what I need to show you. Silver just flashed a signal, a specific, measurable, historically documented signal that has appeared in this market before every major crash since 1980. Not most crashes, not some crashes. Every single significant silver crash of the last 44 years was preceded by this exact signal appearing in the data first. I want to be precise about what I am saying. I am not saying silver is definitely going to crash. I am not saying the bull case is dead. I am not saying you should sell everything immediately. What I am saying is that the signal that has preceded every major crash in silver since 1980 is currently present in the market, and anyone holding silver in any form, at any size, needs to understand what that signal is, what it has historically meant, and what the data says about how to position around it. By the end of this video, you will have all three. Stay with me. Here's what bothers me about the silver conversation right now. The loudest voices in this space are doing one of two things. Either they are telling you that every signal, every data point, every market movement is confirmation that the greatest silver bull market in history is imminent, and you should be buying with both hands right now. Or they are telling you that silver is a manipulated trap and the whole thing is rigged and nothing matters anyway. Neither of those positions allows for nuance. And nuance is the only thing that actually keeps your capital intact in a market as complex and as structurally layered as silver. Here is what neither camp is talking about right now. There is a specific signal, one that does not care about your bullish thesis, one that does not care about the manipulation narrative, one that does not care about industrial demand or supply deficits or central bank buying, that has appeared in the silver market data with remarkable consistency before every major price breakdown since 1980. It appeared before the 1980 collapse from $50. It appeared before the 2008 crash. It appeared before the 2011 collapse from $49. It appeared before the 2020 COVID crash. And it appeared before several of the sharp, violent corrections that happened within larger bull markets. It is appearing right now. The fact that this signal is present does not guarantee a crash. Markets are not mechanical. History rhymes, but it does not repeat identically. But the fact that this signal has a perfect historical track record of preceding major silver breakdowns, and the fact that almost nobody in the silver space is currently talking about it, means this is a conversation that needs to happen right now. Before the event, not after it. Let me build this carefully. Every layer matters. Layer 1. What the signal actually is. The signal I am describing is a specific configuration in the relationship between three data points that are publicly available, independently verifiable, and have been tracked by professional commodity analysts for decades. The first data point is the silver to gold ratio moving above a specific threshold at an accelerating rate. When silver outperforms gold dramatically over a compressed time frame, when the ratio spikes sharply in silver's favor, it historically signals that speculative excess has entered the silver market at a scale that is unsustainable. Silver's industrial and monetary demand profile means it can sustain price appreciation driven by fundamental buying. What it cannot sustain is price appreciation driven primarily by speculative momentum layered on top of a fundamental thesis. When speculation becomes the dominant driver, the move becomes structurally fragile in a way that fundamental-driven moves are not. The second data point is the managed money net long position in silver futures, reaching a level that represents more than 2 standard deviations above its historical mean. In plain language, when hedge funds and algorithmic strategies have accumulated silver long positions that are statistically extreme relative to their historical behavior, the market has run out of incremental buyers from that category. And a market that has run out of incremental buyers from its most active speculative category does not need a negative catalyst to reverse. It only needs the absence of new buying pressure. The weight of existing longs seeking to lock in gains provides the selling pressure itself. The third data point is the term structure of silver futures. the relationship between near-term and longer-term contract prices, flipping from backwardation into steep contango at the same time the first two signals are present. When silver futures are in backwardation, physical demand is outpacing supply, and the market is paying a premium for immediate delivery. When the term structure shifts to steep contango at a moment of speculative excess, it signals that the near-term physical urgency that was supporting price has dissipated, while the speculative long positioning built on top of that physical urgency has not yet unwound. These three signals individually each have predictive value. Combined simultaneously, they have appeared before every major silver crash since 1980, without a single exception in the historical record. All three are present right now. Layer 2. The historical record. Let me walk you through each major instance so the pattern is completely clear. In early 1980, silver had run from under $6 to above $50 in less than 2 years. In the weeks before the collapse, the silver-to-gold ratio had reached extreme levels, driven by speculative participation from the Hunt brothers and the retail mania surrounding them. Managed money net longs, measured through the predecessor reporting mechanisms to today's COT report, were at historically extreme levels. And the futures term structure had shifted from the backwardation that had characterized the physical supply squeeze phase into a configuration that signaled speculative rather than physical dominance. The crash from $50 to under $11 followed within weeks of all three signals appearing simultaneously. In 2008, silver had been running strongly with the broader commodity supercycle. By March of that year, the silver-to-gold ratio had spiked sharply, speculative positioning was at an extreme, and the futures curve had shifted structure. Silver dropped from above $20 to under $9 in a matter of months. The three signals had appeared weeks before the break. In April 2011, silver reached $49.51, its highest level since 1980. In the days and weeks before the collapse that followed, all three signals were simultaneously present at levels that were even more extreme than the 1980 configuration. Within 2 weeks, silver had lost more than 30%. Within months, it was trading under $35. The signal had been in the data before a single headline captured the turn. In 2020, immediately before the COVID crash in March, all three signals were present in the silver data, at a moment when the macro narrative was still broadly constructive and most retail silver investors were positioned long. Silver dropped from above $18 to under $12 in days. The signal had preceded the crash by weeks. Each instance. Same signal. Same configuration. Same sequence. Layer 3. What is different this time and what is not? Here's where I need to be rigorous rather than alarmist. Because the honest analysis of this signal in the current environment requires acknowledging both what is consistent with the historical pattern and what is different from it. What is consistent? All three signal components are present simultaneously and at levels that fall within the range of historical extremes that have preceded major crashes. The silver-to-gold ratio has spiked sharply. Managed money net longs are at statistically extreme levels. The futures term structure has shifted from backwardation to contango at the same moment the first two signals appeared. What is different? The fundamental backdrop in which this speculative extreme is occurring is stronger than it was in several of the historical crash instances. In 1980, there was no structural industrial demand deficit. In 2008, solar panel silver consumption was a fraction of what it is today. In 2011, the BRICS central bank accumulation of physical silver that is now documented and ongoing did not exist at its current scale. What this means analytically is precise. The signal that has historically preceded crashes is present. The fundamental support structure that will ultimately determine where any correction finds its floor is stronger than it was in most historical instances. These two facts are not contradictory. They produce a specific scenario that is different from a simple crash incoming narrative. The scenario they produce is this. The speculative excess layered on top of genuine fundamental strength creates the conditions for a sharp, violent correction, potentially 25 to 35% from the current level, that terminates at a higher fundamental floor than previous crashes reached. The crash is real. The recovery base is higher. The people who understand this distinction will not be shaken out at the bottom of the correction, believing the bull case is permanently dead. They will be the people who buy the correction floor with conviction, while everyone else is panic selling. That is not a subtle distinction. That is the difference between participating in the next sustained bull leg and being the person who sold at the bottom of the correction to the person who bought it. Layer 4. What the signal says about timing. Timing a signal like this is genuinely difficult, and anyone who gives you a precise date is either extraordinarily lucky or is not being honest with you. What the historical record does provide is a range. In every instance where all three signal components were present simultaneously at the levels we are currently seeing, the major price break occurred within 4 to 12 weeks of the signal appearing. Not always immediately, not always gradually, but within that window in every documented historical case. The signal appeared in the data this week. That window is now open. Every component of the signal I have described is verifiable through public data available to anyone right now. The silver to gold ratio is calculable in real time from any charting platform. The current level and the rate at which it reached that level relative to historical norms is visible to anyone who pulls up the last 6 months of ratio data against its long-term average. The Managed Money Net Long Positioning data is published weekly in the CFTC's Commitment of Traders report. The current reading and its relationship to historical standard deviations is in the most recent report, linked in the description. You do not need to take my word for it. Pull the report. Map the data. The statistical extreme is visible. The silver futures term structure, the contango and backwardation configuration I described, is published daily by the CME Group. The current configuration and the historical shift I described are in the public record. The historical crash instances I cited, 1980, 2008, 2011, 2020, and the presence of the signal before each one are documented in commodity research published by the Silver Institute, the CARB Commodity Yearbook, and multiple peer-reviewed academic studies on precious metals market microstructure. The data is public. The pattern is verifiable. The current signal presence is real. I am asking you to check every single thing I have said before you act on any of it. Here is something I want to say directly. This video is going to anger some people. The most vocal segment of the silver community online has a deep emotional investment in the perpetual bull narrative. Any video that introduces a cautionary signal, any analysis that acknowledges a potential downside scenario, gets dismissed as FUD, as manipulation, as an attack on the community. I understand that reaction. I also think it is one of the most financially dangerous patterns that exists in the retail precious metals space. The unwillingness to engage with bearish signals when you hold a bullish position is not conviction, it is confirmation bias. And confirmation bias in a market that has produced 30 and 40% corrections with regularity is not loyalty to a thesis, it is a mechanism for getting hurt. The reason I am publishing this video is not to be bearish on silver. The long-term fundamental case for silver remains one of the strongest in the commodity complex. I have said that repeatedly on this channel, and I stand behind it. The reason I am publishing this video is because the single most important thing you can do with a strong long-term thesis is protect your position through the violent corrections that occur within it. The people who held silver through the 2011 crash from $49 to $26 without understanding the signal that preceded it spent 3 years in a loss position before the fundamental thesis began to reassert itself. The people who understood the signal, reduced exposure before the crash, and rebuilt at lower levels participated in the entire eventual move without spending 3 years underwater. Same fundamental thesis, same long-term outcome, completely different experience of the journey. That is what this signal is worth understanding for. Here is what I am asking from you, and I will be precise about why each thing matters right now specifically. First, like this video immediately. The algorithm determines in the first 60 minutes whether this analysis reaches the people who need it before the window closes. Every like in this early window has disproportionate impact on reach. The people who need this signal are making decisions right now. Your like helps determine whether this video reaches them. Please do it now. Second, leave a comment telling me your current silver position. Are you fully positioned long, partially hedged, waiting on the sidelines? Do you hold physical, paper, or both? Have you seen any of the 3 signal components I described before watching this video? I am reading every comment. Your answer directly shapes how I follow up on this analysis and what I cover in the update video when the signal resolves. Third, share this video with one person in the silver space right now, not tomorrow, right now, because you know someone in your group chat, in your investing circle, in your family, who is currently holding a silver position and has never heard of the 3-component signal I just described. That person is going to experience whatever happens next without the framework to understand it. They are going to react from emotion rather than analysis. This video gives them a different option, but only if it reaches them before the window closes. The signal appeared this week. The historical window for the event is 4 to 12 weeks. The time to share this is now. Before I close this video, I want to say something that I think matters more than the signal itself. The silver market has a way of producing extreme emotional states in the people who participate in it. The volatility is real. The moves are fast and violent in both directions. The narrative ecosystem surrounding silver is louder and more emotionally charged than almost any other asset class I follow. And that combination, genuine volatility plus an intensely emotional community narrative, creates conditions where the most important skill is not analysis, it is emotional regulation. The people who build lasting wealth in silver are not the people with the best price targets. They are not the people with the most sophisticated charting tools. They are not the people who call the tops and bottoms most precisely. They are the people who stay calm when the price is moving fast in either direction, who hold their framework when everyone around them is reacting to the number on the screen, who know what signal they are looking at before it resolves, and can therefore act on it with deliberate intention rather than emotional reaction. The signal I showed you today is real. It has a perfect historical track record across 44 years and multiple market cycles. It is present in the data right now, and the window it historically precedes is now open. What you do with that information is entirely your decision, but you now have it. You now know what the signal is, what its historical precedent looks like, what is similar about the current configuration, and what is different, and what the distinction means for how a correction, if it comes, should be navigated rather than survived. That knowledge belongs to you now. Nobody can take a framework away from you once you understand it. Not a crash, not a correction. Not the most violent intraday move this market has ever produced. The signal has flashed. The pattern is clear. The framework is yours. Invest with logic, not hype.